There's been a deadline extension that we're going to be talking about. There's SBA economic injury disaster loans. I mean, this is up to $2 million. There's paycheck protection programs. There's employee retention credit refunded through FICA taxes. There's net operating losses that you can carry back for 5 years. There's 2020 recovery rebates for individuals. And there's even provisions where you can get money out of your retirement plans before 59 and a half without penalty.
Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions.
Hi, Garrett. Gunderson here, New York Times bestselling author and financial advocate. And in this time of chaos and confusion, I brought in one of the experts of our elite accredited network, David Bull, and we're going to help people navigate. Look, we've got 3 IRS notices. We've got 3 acts. And what does all this mean to business owners? So first off, there's been a deadline extension that we're going to be talking about. There's SBA economic injury disaster loans. I mean, this is up to $2 million. There's paycheck protection programs. There's employee retention credit refunded through FICA taxes. There's net operating losses that you can carry back for 5 years. There's 2020 recovery rebates for individuals. And there's even provisions where you can get money out of your retirement plans before 59 and a half without penalty. So there is a lot that we're going to cover here today. This might be the most instrumental thing to get money for your business to survive or make it through. And for those that make it through, I think there's going to be so much opportunity. So I really want to help you out. Now, David came in to my life and really saved me massively on taxes with some of his strategies. So he's one of my go-to guys. David, thanks for spending some time today.
Yeah, absolutely. Happy to help.
All right, let's just pull up and just start going through. I know you built an entire slide deck that can kind of help us navigate. And I'll let you just kind of start in everything I just said, where you want to start and what that means and what people need to start doing immediately and what's possible for them.
Sure. Let me go ahead and share my screen here.
Great.
Yeah. So as you just mentioned, we've had several acts, several notices that have come through just recently in the last couple of weeks. And in that, there's a significant amount of opportunity. So we've had the Families First Coronavirus Response Act, the Coronavirus Aid, Relief, and Economic Securities Act, the Coronavirus Preparedness Response Supplemental Act, Appropriations Act, and a few different IRS notices that have come out along the way to provide some guidelines around when filing should occur, when tax payments should occur, et cetera.
Yeah, we're even going to get into some income smoothing. Like there's some really strategic things you can do from a tax standpoint. But, I think the first part looking here is really where can you get cash? Where can you get this bridge? Because I feel like the next 90 days are truly critical for so many businesses.
Yeah. So thinking through some of the main takeaways, just some of there's tax credits available. There's some mandates, but it's okay because the government's coming through and trying to alleviate some of that with some credits that could make the mandate really not much of an issue. Low interest SBA loans, forgivable SBA loans, additional credits for employee retention, deferring FICA taxes, which can be a burden for a lot of larger employers, massive stuff related to net operating losses. I think people aren't talking enough about this one. Charitable deduction increases, and as you had mentioned, some areas around the qualified plans as well.
Right, David knows this stuff, at a really deep level. I'll be looking for the common viewer, like people that this isn't the vernacular language that we use every day, and help you kind of decipher through that. So, David, once again, I'm thankful you're doing this. So let's look at who this is going to help most.
Yeah. So as far as who does it help? Most every single American. We've got called out a few people here as far as anybody that had a tax liability due in April 15th. This helps because of the delay now until July 15th. Any business that has W-2 payroll costs and really any form of independent contractor costs inside of their business in the last 15 months, and even in the last 3 months, if they started this year, it could likely be available as well. Any businesses that benefit from low interest capital, businesses that had losses in the past. Outside of the business world, any individual that made less than $100,000 in the last couple of years, or a married couple that made less than $200,000 in the last couple of years. Anyone that's done any business that's done renovations on their property, active business, active real estate businesses. There's some really amazing things that can occur here. People with student loans, employers with employees with student loans, employers that want to help their employees in other ways through the crisis, whether it's through childcare expenses as well. And then, we're not going to go into this probably too much today, but the recent acts have obviously helped big business as well, which will trickle down to the rest of the economy.
Great. Thanks for the overview. So let's get into that.
Yeah. So as far as how's it going to help? Really the way I'd summarize it, it's going to bring a lot of capital to a lot of people quickly to be able to allow them to get through cash crunch, to get through to help keep operations going, and for a lot of people, help them grow their business to a new level. So one of the first notices that they brought in, this was, I think, the first things that they had come across. It came across 3 different notices. The most recent one was the 2020, which was essentially talking about the April 15th, any tax liabilities due for 2019 taxes or for 2020 estimated taxes. First, there was a limitation. That limitation is now gone. Doesn't matter if you have millions of dollars of tax due on April 15th for 2019 or estimated taxes or a combination of all of them. Both the filing themselves and the tax liability themselves are no longer due until July 15th at this point for almost every type of return. So individuals, trusts, estates, corporations, there's a few special returns that still are due at April 15th, but by and large, 99% of returns have now been extended to July 15th, and nothing is required out of a person to benefit from this.
Got it.
Families First Coronavirus Response Act, HR 6201. This was the first act that they passed. They got this through Congress actually with much less dissension, unlike the CARES Act, which we'll go into here in a little bit. So this is the first act that really started benefiting employers. It didn't look like it was going to be that way at first because it was a mandate. It was a mandate that employers give 14 days of sick leave, paid sick leave at 100% pay to any employee that has some specific illness related to to coronavirus COVID-19, or as it says here, includes any employee subject to government quarantine, isolation order, advised by a healthcare professional, seek self-quarantine, etc., which is now transitioned to most of society here in America. It's probably under some order, whether it's by their state, municipality, government, etc. But with it has come this benefit. So the government mandated that employees provide this, but the government made up for it by saying any employer that allows their employee to go on sick leave and chooses not to lay them off instead will be refunded up to $511 per day per employee through FICA tax credits, which means at the end of that quarterly tax filing that you'll make, there's going to be a checkbox on the typical 941 that an employer makes with their payroll taxes. And on there is going to say, I want a part of my FICA tax withholding to be credited back to me to pay for this amount of money that I spent on sick leave for my employees. And if there's not enough withholding for the employer to pay those bills, then no problem. Then the government will send a refund check, assuming you asked for it to be done, which is likely to be the case for most people.
Right.
There's a similar mandate for employees that aren't sick themselves, but may have a family member that's sick or a child that was sent home because their school was closed. That mandate is for 2/3 of the employee's pay, and the government, again, is willing to pay up to $200 a day in credits per employee for that 10-week period as it relates to that mandate, and maxed out at $10,000. Similar way of refunds to the 941.
And so your accountant needs to understand this, right? That's the main person.
Yeah, and so splitting that into 2 components, probably, your bookkeeper, whoever's your accounting, your bookkeeper, whoever's filing payroll, if you've got those roles separated, they need to be all over this. If you haven't historically tracked sick leave well with your employees or in your payroll, you need to start tracking it well. You all need to understand the mandate. Employees are some naive and some not, and looking at this, and I've already heard from multiple other sources where businesses have their employees coming to them and say, hey, I've heard about this mandate. I'm sick, or my child is sick, or my child has been out of school, and I'm going home and you have to pay me. So you need to be prepared ahead of time for not just the tax side of it, so that you know how to handle the cash flow, but also the operational side of it as well, on how am I going to handle my business and then to have a large pool of my employee base leaving due to the mandate.
Got it.
There's a timing issue with this as well that you need to take into consideration, because it's going to come through a refund at the end of the 941. The employer is going to obviously have to continue making those payroll costs all the way through the quarter. And if there's not enough withholding to pay for it at the end of that quarter, you're going to have to apply for a refund, which with the government might take several weeks. So you got to keep in mind the timing.
Yep.
The same type of credit is not just for S corporations or businesses with employees. This also applies to a self-employed individual, a gig worker. You could be an Uber driver, for example, and receive the same type of tax credit. So if you're a self-employed individual, you can get up to $511 per day credited back to you on your self-employment tax for 10 days total from the government. And then the same type of 10-week cap per day, or at $200 per day for a self-employed individual. So really unique thing that I haven't seen before.
Yeah.
All right, so we switch over to a different component, the EIDL, the Economic Injury Disaster Loans that have come out.
How hard do you think these are going to be to get? And how quickly is the money going to get used up if you're to speculate? Are those concerns for you?
I think both are concerns. I have yet to see one person approved and get the capital. You can go online to SBA.gov right now and apply for these loans. I personally prefer the route of going through your own banker. I think it provides for probably a little bit more ease if you don't have a banking relationship. I think SBA.gov is fine. I think for specifically these economic injury disaster loans, which are different than the payroll protection loans that people are familiar with that have come out that are forgivable. These are the non-forgivable loans, but they are low interest at 3.7% and have a 30-year payback. But there's also a requirement to show some form of hardship related to the COVID-19. So if you're a dentist, you're a restaurant, this is going to be a no-brainer. These loans are going to be very easy to receive because your business has been highly devastated. If you're an online service business or online marketer, this might be a little bit harder to show because there's likely going to have to be some proof that you're either going to issue layoffs, you had a reduction in revenue, you're come into a cash flow crunch, not be able to pay rent, some type of hardship. So you've got to look at your business and decide whether or not you're struggling and be able to prove that. And frankly, we still don't know exactly what there's not a hard and fast rule on on what the criteria is. There's more of a intent that was written for this that then the banks are going to decide. So just because one bank turns you down doesn't mean every bank will turn you down. I would apply again if you're turned down the first time and you feel like you're owed this loan.
Yeah, right when this came out, one of the lenders in our network called and was on hold for a couple hours with the SBA, never got them to pick up, answer. So all I could do is go through the old protocols that they knew or anything that was posted. So, I would be a little leery of this one. There's better stuff to come as you're watching this, but you're right, 3.75%, that's pretty cheap money. I mean, yeah, the Federal Reserve has gone down to nothing, but, institutions are still charging something. So they could still be pretty profitable during this time if there isn't massive default, which is going to be a big concern. And just one point I would make is I'd be really calculated and careful with regional banks and smaller banks and be thinking more of the largest institutions where you're storing your cash right now. Because even if we go back to the savings and loan debacle, a lot of those companies, it took them 3 years to get the federally insured money back. And who knows how bumpy this ride could get, but something to be mindful of. So just as we're on this topic quickly about banks.
Yeah. As a practical matter, I'd say for anybody getting this loan, set up a separate bank account, deposit the loan proceeds into that bank account, because you want to follow the rules of what the loan is for. It's specifically to be used for fixed debts, payroll, accounts payable, and other bills that cannot be paid specifically because of the disaster's impact. Who knows if they'll actually go back and audit it. but it's going to be much easier to prove that if you just put the proceeds in a separate account and transition any of those specific expenses to that account. Really, they're trying to get away from people putting this in the business, distributing it out themselves, and going and blowing the money.
Right, which people are going to abuse, just like we saw in 2008. So
right,
it's important. Yeah.
Yeah. Okay, so the big act that came out that we didn't know if it was going to get passed because they were trying to put a whole lot of other fat in the bill. That
thing was so big, man. It was like it was
right.
deep. I say that as garbage. Like, we're in the middle of everyone really wanting to come together, help each other out. Like, the one time that we're really counting on a government to do something, and what do? Bring tons of personal agenda and bureaucracy, which is disgusting. So now I've said it, we can kind of move on with what it is at this point.
That's right. Yeah. So it's over a $2 trillion package, of which there's really only a smaller carve out for small businesses. So the small business, which we'll really talk about today, is $377 billion, which to some might even still seem like a big number. But when you really break it down, that money is going to go by real quick. It's first come, first serve money. And I don't think that $377 billion is going to last long, especially with how people are going to be able to qualify for getting it. So let's dive into it.
When you say first come, first serve, what determines first come, first serve, and who's in line? And should they be in line already, or does that open up in a few days on April the whatever?
Yeah, those are great questions that I don't think we have yet to be answered. So some banks out there have a program that they're putting in place. I know, like Live Oak Bank, which is a more prominent bank name, has a specific program where they're saying, yeah, we'll take on people in a certain order where actually you can come in and apply specifically with the bank. You can't actually apply for this program yet. The regulations are not out. Banks have not received funding and they have not received action from the SBA. That's anticipated to be in its first form on Friday. They're probably not going to get funding for 3 weeks, which means no one's going to really see any money in a real extent for 3 weeks. We'll get into another nuance there. There's going to be some money available, but likely applications won't be able to go through until the earliest Friday. But because it's first come, first serve, and you must do this through one of your banking programs, I would highly consider getting with your bank and trying to get in line. Because as soon as you can get in line, it's going to be able to put you up higher on the list. And if you get in line this week with your bank, more than likely you'll be able to get the proceeds. If you wait till next week, 2 weeks, 3 weeks, a month out,
gone.
I can't possibly see how this money is being used or how it's not already used up.
Yep.
So let's dive into what it is. So this Paycheck Protection Program. So it's an expansion of SBA 7A loan, which is the most common type of SBA loan that people are familiar with. It's capped at $10 million per business. You have to have less than 500 employees. This is a big deal. It's non-recourse, no personal guarantee, and no collateral required, which is not typical of the SBA program. So the SBA program, although a government-funded program that provides loans to small businesses, they're typically recourse loans. A lot of times require personal guarantees and collateral. In this case, none of that occurs so long as you follow the rules, and we'll go over that here in a minute. In the event that the whole loan is not paid off, you have 6 to 12 month loan deferment on any remaining amount balance, any part of the loan due. And the big piece that I just mentioned in part, the whole loan can be forgiven so long as we follow a few pieces of criteria, which big deal.
Yeah, and by the way, on our conversation that we were just having, Jeff Soha, who's part of that you're partners with, he said that there might be a possibility to get $10,000 emergency cash grant with the EIDL that doesn't have to be paid back, and by getting an application in can refinance. So the SBA updated it and says banks should be ready to take apps just here on April the 3rd and fund it in 3 days. It's a 2-year note, 0.5% interest, 6-month deferral. So I mean, this kind of stuff, like, you guys are around the clock just researching it and sharing these things.
Yeah, no. So that $10,000 component, that's a good part to bring up. And that also is a first come, first serve. And I think it's limited to the first 1 million applicants. So just another reason to hurry up and go. So,
Right.
so as it relates to the payroll, oh, sorry, did I cut you off? So as it relates to the payroll protection loan, it's a 4% interest rate, a little bit more than the other. But again, the interest rate probably doesn't matter here. The payment deferment is 6 to 12 months on both the principal interest and any other fees. The banks are paid by the SBA, so they're incentivized to actually help everybody here. Participating in the payroll protection, I have lots of questions around this because I think there was confusion, as always is with anything that the government puts out. Applying for the payroll protection loan does not make you ineligible for the EIDL loan, and vice versa. You can actually apply for both. In fact, one of the weird things inside the bill, the payroll protection loan, one of the ways that they figure out how much money you're going to receive is they say, we'll get into this 2.5 times your average payroll cost. We'll break that down. But also including in that is any principal interest outstanding on any other type of economic disaster loan. So the question is, does that mean I can go and apply for an EIDL now, get approved, then apply for a payroll protection loan and get that added to my payroll protection loan, actually converted into my payroll protection loan, then have my entire EIDL also eligible for forgiveness? The answer is maybe. So we're just telling everybody low interest capital, in our opinion, makes sense. Let's go ahead and get it. And in the event this turns into a double benefit where we're able to lump that into the payroll protection loan and get additional forgiveness, terrific. I don't anticipate that that was the intention that they were trying to come across. I don't think it's probably going to hold up, but if it does, it's just another reason to, put your ducks in a row and apply for everything you can get.
Right.
Went over a lot of these different things. The only thing that I didn't mention on here as it relates to this program is it is going to require a good faith certification. Again, different than the EIDL. That one, you're going to have to prove some form of hardship. This is likely not going to be the case. This is going to be more of a checkbox that says, yeah, I need this. And because if I don't get it, I'm not going to be able to meet certain criteria. The regs might come out and expand on this further and maybe require banks to dig in a little bit deeper. But in the way that they wrote it, it's seemingly going to be more of a checkbox type of issue. So I wouldn't be as concerned as it relates to the payroll protection loan that you're in some major economic disaster in order for you to receive this. I think any business that's going to apply, assuming there's funds remaining, is probably going to be approved.
I mean, as you're talking about all this, I'm like sending emails to my banker. I mean, you know what I'm saying? Like,
right.
I'm a bad host all of a sudden, but I'm like, no, I gotta act quickly on this.
Right. No, you should. So you can't, if you're a business, how do you qualify? Well, you have to have less than 500 employees, or if you're, a large restaurant chain, or you've got a massive operation or Cairo operation or whatever it may be, and you have more than 500 employees across your entire business group, but you have multiple locations, that's fine. That 500 limit can then apply to those different locations. So lots of questions around, well, according to health insurance, I fit these different rules. And so, under a health insurance program, I'm not under a 500 limit. Well, this isn't health insurance. It's different. They put in a specific per location clause here, which allows restaurants and other large chains, whether you're a chain or not, just businesses that are more umbrella businesses, to be able to continue to participate. As well, it's eligible to sole proprietors, independent contractors, self-employed individuals. So again, this is where, people, as this loan was being, Uber, I think people were talking about in the news, how are Uber drivers going to get paid during this time? Who's looking out for them? This was kind of their way of saying, we'll look out for them. They can go get this payroll protection loan as well. Okay, so now should we get into the weeds a little bit?
Let's get in the weeds. Yeah, definitely.
All right.
As we're talking payroll costs, if you're using like a PEO, like a payroll service company, are the big ones going to understand all this, or is it still something you got to rely on your own controllers, bookkeepers, or accounting firms to handle?
I would think that the payroll companies should get on board with understanding this. Some of them I could potentially see saying, hey, look, we're not going to interpret any of this for you. You tell us what data we'll need and we'll provide it to you. I would imagine some of the bigger players are probably going to figure this out at some point. But to that point, the regulations haven't come out yet, and
Right.
I myself am confused. I've read different areas of this code over 50 different times trying to interpret what they said. I've spliced it up. I've removed commas. I've removed words, reinserted words, and grammatically they don't even make sense. I mean, there's literally sentences that are incoherent. So I'll give you my best interpretation. Some of it is solid, factual, likely will not change, and some of it we'll see how it ends up playing out. But this big component is, what is payroll costs, and they define it. They define it in the code. So it's salaries, wages, commissions. That one's pretty straightforward. Tips, paid sick or medical leave, healthcare payments, retirement benefit payments, payment of state or local tax assessed on compensation of employees. So when you do your payroll, this is not your FICA taxes. Those are federal taxes, but most taxes have some form of state payroll tax that goes along with everything. And then there's also this component that says compensation paid to independent contractors. It's not that clear in the code, but when after about the 30th or 40th read through, it's very much could be interpreted as a compensation paid to independent contractors. In fact, that's how I believe it was probably intended to be written. Likely will come out. They might change it in the regs, but I believe right now payroll costs also includes independent contractors. Now that leaves an entire can of worms on, well, who on earth are independent contractors?
Right.
Are they anybody you give a 1099 to? That's what I would do if I were the government, to be able to audit this thing. But theoretically, you may not provide a 1099 if it's a single individual that so happens to have their own business, taxes, and S corporation. They're not going to get a 1099. Are they an independent contractor? Yeah, but they're not going to get a 1099. So how's the government going to be able to know, and how are you going to be able to report it? So lots to figure out there. That's going to be the biggest place that we're trying to get definition on. And if they open this up for application by Friday, they don't pass the regs until 3 weeks from now, it means that the banks are going to have to make a judgment call on whether or not they include those expenses in your loan or they don't. And so what am I recommending? I'm recommending that you vet it out on the front end with the bank. And if they don't know today, then call them tomorrow. And if they don't know tomorrow, call them the next day and try to get their stance on what they're going to do as it relates to how much money they're going to give you. Because if they're not going to give you the independent contractor component inside the loan, then I'd start working with banks that will. Because for many individuals or many businesses, they've got a lot of payments out to independent contractors. So I think that's where it's going to land. It also includes income of sole proprietor. So on the flip side, if I'm a sole proprietor, I don't have an LLC, I don't have anything, I just make some money here on the side, I can take all of the income I earn myself, and that's actually going to be considered a payroll cost as it factors into figuring out how much I can get in a loan.
Yeah.
What doesn't it include? What do they exclude from payroll costs? Really two things. They exclude any salary above $100,000, compensation above $100,000. They don't exclude that entire person, but they just exclude all the amount above it, right?
Got it.
And then any credits that were received through that Families First Coronavirus Act that I had mentioned beforehand. So if a business ended up getting some of those credits on whatever wages related to those, the payroll costs are going to be excluded from those wages as well.
That one's an either or right there. Not all these are, but that one is.
Yeah, that one's an either or. But I think that one's an okay either or. And that Families First Act also lasts past this covered period, so to speak, for the payroll protection loan. So, it may not count for the payroll protection loan for a component, but then also still applicable throughout the remainder of the year.
Got it.
So how do we figure this out? Well, it's 2.5 times the average monthly payroll cost. We just went through all what these payroll costs were. So it's 2.5 times the average monthly of those costs incurred over the last 1 year period prior to the date that I make the loan. So if, for example, I could get this loan on Wednesday, April 1st, then I'd be able to take all the last 1 year period from April 1st of 2019 through March 31st of 2020 this year. Factor in, figure out all those different costs, come up with the average monthly amount over that time after I exclude any excess amount paid to those that made more than 100,000. Multiply that by 2.5, and I get my total amount, assuming it's less than $10 million. If it's more than $10 million, then I get $10 million instead. And then, like I mentioned beforehand, there's this additional component about the EIDL principal being added to this loan. So if you have an old EIDL from maybe a disaster in the Northeast a few years ago with the hurricanes, or the hurricanes down in Houston, or I would assume most of the people have paid off the loans from Katrina or whatnot back in the day. But any of those continuing loans can be rolled into this. And then, you know, if you interpret it appropriately, I suppose this new EIDL could also be rolled into this, but I can't imagine that was the intent. We'll see. So let's talk about allowable use, which is different than forgivable use. And of course, they don't want to make them the same criteria. I don't know why, but if you're not aware of the criteria, then it could actually really hurt your benefit with this. So this is where terms matter a lot. So as it comes to allowable means if we follow these rules, we get to keep that non-recourse benefit, that no personal guarantee benefit, that not having to put collateral, not having some banker call me up and check in with me, and looking at financial statements and my credit history and all these other things that we don't like about loans. We don't have to deal with any of them so long as we follow the rules. So these are the rules. The money has to be used for employee salaries, wages, commissions or similar costs, healthcare benefits, all the other payroll costs we talked about beforehand, payments of interest on any debt obligation on real estate or personal property, rents, and utilities. Someone asked me a good question yesterday on rents. Does it just mean property rents? Well, the way they wrote it, it's pretty vague. And so we would also think that this would include, you know, rental equipment, other items they rent, any property rental. It's actually specifically calls out property rental. The intent might have been real estate property, but they left that out. So that might be further defined later. And if not, then I would assume any type of rent would count here. So the difference between allowable and forgivable, it's all the same items, except the one thing that they got rid of was around what debt interest counts. So mortgage interest specifically, and remember, this is a business loan. So this is not my home mortgage interest. This is my business that happens to own a piece of property and the interest on the mortgage that I have with the bank. Most businesses, likely if they're structured well from a tax standpoint, probably don't own real estate unless they're a real estate business. But in the event you have one and you have a mortgage on it, then this is a forgivable expense, the interest portion. But a lot of businesses are going to have other forms of debt. Either they purchase the business through some form of debt, they have equipment debt, maybe other forms of short-term or long-term debt. The interest on those debts, although are allowable and will not break the rules from the non-recourse personal guarantee, collateral, etc., they will not be forgivable. And so most people that are interested in this payroll protection loan are really trying to say, hey, look, I'm going to go get millions of dollars from the government, and the government's going to wave a magic wand and not make me pay any of it back. Well, if you want to make sure that that happens, then you need to spend all of the money specifically on these payroll costs, mortgage interest, rents, and utilities in the 8-week loan period. That's the date from the loan for an 8-week period following the date of the loan during that period of time, and use it up there. Again, like I mentioned on the other loan, put it in a separate bank account and pay for all these costs there. Meaning you have rent due, great. Don't pay rent automatically out of your typical checking account. Write a check and cut it from this account. Same thing with utilities and payroll and everything else. It might be a pain with payroll. You have to work with your payroll provider. They should be used to just giving them a different accounting and routing number to pull the funds from. I recommend this would be the easiest way to do that. At the end of this period, you do have to prove that you are owed forgiveness. I believe if you intermingle these funds inside your operating account, you are going to have a very difficult time going through and proving the forgiveness. You can do it. It's just an unnecessary pain. I think the pain in setting up a separate account, running everything through here, and at the end, likely with the bank that you got this loan from, them able just to pull up that account and see that all of the expenses are approved. It should be a very simple process.
That's good to hear. It's good to hear.
Okay.
Yeah.
So forgiveness. I made it sound simple, or maybe not simple, if you just use those 4 different costs. So those 4 different costs that we talked about beforehand, if I go back for just a moment, this comes up with the total amount I can be forgiven. So if I can back up for a moment, let's say I get $1 million loan for easy math, and I come up with $1 million worth of payroll costs, mortgage interest, rents, utility in this 8-week period of time that I can apply towards this loan. Well, then great. So I've got $1 million from the government. I can get $1 million forgiven from the government, but there's always a but. Now I've got to consider, do I have any discounts against that forgivable amount due to a couple pieces of criteria? So there's 2 pieces of criteria. Let's go over the first one. So the first one has to do with headcount. That's full-time employee, equivalent employee. If you're not familiar with what that is, guaranteed your accountant or your payroll provider is. It's essentially a specific formula on how many people are working, how many hours per week, capped at 40, and they take the total hours divided by 40 and come up with your full-time equivalent employee. This does not just mean how many full-time employees you have. It's a very different term. It's full-time equivalent. But if you look it up, or if you ask your payroll provider, they should be able to give you a very specific number here. So what do? We take our $1 million, that forgivable eligible cost that we have, and we multiply that against how many full-time equivalent employees we had per month during the covered period. Now, the covered period, for the sake of this discussion when it comes to the loan, is this period from February 15th, 2020 to June 30th, 2020. So it's not this second quarter. It's not the covered period of the loan itself. This is from February 15th of this year all the way through June 30th of this year. You divide that number by the same time period with the average full-time equivalent employees that were employed during that time. So if last year, same time period, I had 10 people, this year, same time period, I employ 10 people, then it's 10 divided by 10 equals 1 equals 100 times my 100% times my forgivable amount. I have no discount. If that formula is less than 100%, then it's worth looking at the other formula to see if that's preferred, which is essentially just a different time period to compare against. So if you don't like last year's time period for whatever reason, then compare it against the other time period. That's going to be January 1st, 2020 through February 29th, 2020. Really, at the end of the day, these formulas might look complicated on this picture here. They're not. Just pick the time period that has the fewest employees. That's going to give you the biggest benefit. So just note, you have 2 time periods. You're not stuck to one. Pick the one with the lowest, and then do your best to figure out from a headcount perspective that you have enough hours of people employed that your headcount, that your total FTEE per month over this period of time this year, February 15th, 2020 to June 30th, 2020, is going to be equal to or greater than the time period that you choose. Make sense? I further broke this down here, giving that same example. We go with it for a minute. You take that $1 million of eligible costs, 2 different time periods. One of them I have 12. The other one I have 10, and I'm going to have 9 people covered this year. So in both situations, I have less, but I want to take the lower. So I'm going to take the 10 over the 12. If I do so, then I take my $1 million of eligible costs. These are for the forgivable costs. I multiply that against the 9 people I'm going to have employed on a full-time equivalent basis during the covered period. That's this year, February 15th to June 30th. And I divide that by my best of the 2 scenarios, which happen to be January 1st, 2020 through February 29th, 2020, which is 10. 9 divided by 10 equals 90% times $1 million means I'm going to have $900,000 of my $1 million eligible for forgiveness.
Got it.
Okay, that's factor one of the reduction. Then we get to factor two for the reduction, which, if you read this section of the code, I don't know who wrote it, but and hopefully multiple people wrote it, but it can be improved. Let's just say that. And we're going to be looking for it to be improved upon when the regs come out. So the way that it reads, forgiveness is reduced by the amount of reduction of salaries or wages of any employee, not employees, not total employees, not average employees, not full-time equivalent employees over a period of time, wages of any employee that is in excess of 25% during the covered period. That's that February 15th, 2020 to June 30th, 2020, compared to the most recent full quarter. And actually, I take that back. The covered period related to this specific component is the 8-week covered period of the loan. Or actually, it's the second quarter, so from all the way through the end of June 30th. So now this brings in a weird question. Okay, I met my full-time equivalent headcount. I had 10 people employed. I'm going to have 10 people employed, but one of those people aren't the same people. You know, I had Frank employed. Frank doesn't work here. Now Jim took Frank's space and everybody else is the same. What does that mean? The answer is we don't know. If you read it like the code says and you take it literally, then essentially you took Frank from 100% of his pay down to 0% of his pay, which means you're going to have a dollar for dollar reduction in your forgiveness for every dollar below that he was not paid below his 25%. So if Frank was being paid, let's say over the course of that quarter, $15,000, or let's just use your math, $10,000. Well, 25% is $2,500. So if I reduced his pay by $2,500, that's okay. No harm, no foul. But if I take him to zero because he quit, he got fired with cause, we laid him off, we furloughed him, whatever, it doesn't call out any specific factors, then I'm probably, according to the code, going to have my forgiveness reduced by that $7,500 from the first 25% buffer, no harm, no foul, and then the remaining $7,500 I didn't pay him, my forgiveness is going to be reduced. I don't think this is going to stand. I don't think that was the intent. I think that the purpose of this component was to say, if you furloughed or laid off employees, we want you to be able to rehire those people. In fact, we're going to make you rehire those people because we're giving you a bunch of money to do so. And if you don't, then we're going to penalize you. I think that was the intent. I think this was their reason for putting this component in, but it turned into this really weird scenario of, can employers fire employees with cause? If employees are trying to quit, should the employer try not to get them to quit because it's going to penalize them? I can say with confidence that likely around laying off employees, that part's going to stay in here because I think that was the intent to begin with. So don't have more clarity other than that right now, other than to say, be careful until these regs are done on making decisions with your employees. If it's a decision that has to be made and you cannot wait, I'd make it. If it's a decision that can wait, then I'd say wait.
Got it.
There is an exemption. So for those that are in a bind, you know, dental shops, for example, that have been literally shut down, or restaurants that have been shut down, and it makes no sense for you to continue the payroll costs. It's going to put you, you know, potentially into bankruptcy if you continue these payroll costs. If you've already laid off employees, or you have to lay off employees for the sake of this next payroll, or if you laid them off but there's a payroll coming up and you're trying to figure out if you should pay them, I'd say don't. If you're in a situation where you need to lay people off, go ahead and lay them off, or furlough them, or do something, whatever your business requires from an operational perspective. I wouldn't wait on the government to figure out their regulations to determine whether or not this is going to be of benefit or not to you. There's an exemption that they gave that anybody that's rehired within 30 days of enactment of this CARES Act. So we've got 30 days from last Friday. If you rehire anybody that you laid off, it'll exempt you from the FTE count, the head count test, and it also will exempt you from the salary reduction test. So all of these people that you may have laid off, if you bring them back on within 30 days of last Friday, then it'll be as if then these factors, these reductions won't count against you for those people. There might be a different piece. I can't recall if that rehire date is also retroactive pay. I'll have to get back to you on that. I can't remember that off the top of my mind. But they specifically wanted to say, hey, look, the government came out and said we're making more generous unemployment packages for those that have been laid off. And so if we're going to pay out this money anyways to employees, why don't we just go ahead and pay it out to the small business owners that are employing them, give that money to them so that they can give it to the employees so that the employees can continue to get the economic wheel turning in our country. That's the intent. It was a great intent. We just need a little bit more regulations to make sure that that intent is actually going to come through.
Yeah, and what's interesting, I mean, if you think about it, we got more small businesses hiring people than corporations in totality. There's more employees for small businesses than large corporations. So pretty essential here.
Right. Makes you wonder why small businesses got so little of the pie, doesn't it? All right, let's continue on with businesses. So this is another really interesting credit for small businesses. This isn't going to apply blanket statements. So a lot of people are really fired up about payroll protection loan because almost any business that meets the eligible threshold of less than 500 employees is going to qualify, and it's likely something that's going to add value either in the thousands of dollars or in the millions of dollars even for them. The refundable employee retention credit is a credit specifically going after businesses that are really struggling due to this virus. So if you are a dentist, you are a chiropractor with a large clinic, you are any other form of like a restaurant, some type of service business, a retailer, then you've had to close your doors due to government isolation orders, quarantine orders. Your revenue has taken a sharp decline in the last 30 days. And if we continue to have these isolation quarantine orders, your revenues probably continue that sharp decline for an indefinite period of time. So what this employee retention credit was kind of piggybacking off the payroll protection loan, and specifically going after these employers saying, okay, look, we understand you're really struggling. And the payroll protection loan, after you do the complicated math and figure out the strategy behind it, you're going to realize, oh, wow, that loan doesn't actually really pay for the employees for the total period of time that I have to keep them employed. If you want me to break that down further, I can a little bit, but you'll take my word for it right now. When you look at it, it doesn't really pay for all the payroll costs. And if you're a business that your revenue has gone to, let's say for extreme example, 0,
right,
you're not incentivized by the payroll protection loan to take that and pay the amount of payroll costs over the next second quarter. It just, the math doesn't work out. So what they've done is they come out with this employee retention credit. When you add these two together, all of a sudden the math starts to work out. So here's what it means. If you get a credit equal to 50% of qualifying employee wages, up to a total of $10,000 per employee per year, really just in 2020. So this is not a $10,000 per month wage or per quarter wage. This is the first $10,000 of this employee, they're going to give you a 50% credit for that employee, which means if you had an employee, let's say, make $10,000 over the course of a quarter, then you're going to get $5,000 credit for that employee. How do you qualify? Well, you have to have a significant decline in gross receipts. If I can recall how this is calculated, we compare one quarter versus the same quarter last year. So if in the first quarter you had greater than a 50% decline in revenue due to COVID, so you have to show that this was due to a government isolation order, quarantine order, many people in your organization getting sick, or due to schools being shut down, it took a cost in your revenue. If this is just some other reason, this is not going to account. But most businesses that are struggling can very clearly say, well, the government shut me down, so clearly my revenue's down. So if your revenue's down by more than 50% in the first quarter compared to the first quarter last year, or if you take that same vein, second quarter this year compared to second quarter last year, then you immediately become eligible for this retention credit during that period. Similar, I believe this is going to be refunded through FICA tax credits. So when you go to file your 941, If that quarter, your revenue was down by more than 50% for the quarter before, you should be able to apply those FICA tax credits as a credit per employee up to 5,000 per employee, assuming that the wages were around 10,000 in that period of time. So couple pitfalls. And then there's obviously, if you had the section 7001, 7003, that Family First Coronavirus Response Act that gives you the credits for the sick leave, obviously you can't double dip. So it's going to be one or the other there. So if you got some credits, then those would go against the total amount that you're going to receive. This one's also refundable, meaning if you don't have enough withholding, again, you can apply for the government to send you a refundable credit. Some pitfalls with this. Notice it's a 50% decline. So question, what if it's a 49% decline? You don't qualify. So if you're on the fence, like I was talking to a client earlier today and they said, okay, well, my first quarter didn't work. My first quarter, I wasn't at 50%. I was only at a 20% decline because I only had to shut my doors for 30 days. And this next quarter, if the government lets me reopen in the middle of June, I might not be at 50%, but I might be at 40% decline. So you got to kind of run some math figures here to say, assuming my doors are shut and I start qualifying for this credit, is it worth it for me to open my doors back up or not? Because if you're really close to the line, being at 49% decline versus 50% decline can mean major money. For a client, for a certain individual, they might say, all right, I'm pretty confident going into this next quarter that my business is likely going to decline in a significant way. So I'm going to go and take that payroll protection loan, get my money there, plan on getting this credit. If the turn around and say business operations are back to normal, go back to work by Easter, like Trump had initially said and now extended, okay, fine, I don't care. I don't need this credit. I've got this incredible payroll protection loan with revenue coming in. I'm going to get that whole thing forgiven. We're off to the races. And maybe the same thing. If May 1st comes along and business is open back up, maybe I still feel good about it. But if maybe June 1st comes along and now business opens back up, I need to evaluate whether or not I want to actually open my doors, because now if I open my doors, I might not hit this threshold because I'll have too much revenue coming in that last month. That might actually put me further backwards.
Stuff, right? This drives me crazy.
I know.
It's like anything that would lower the incentive to be more productive is nuts, right? And
right.
I get, yeah. I mean, anyway, all right. That's my 2 cents there. Yeah.
It doesn't make sense. So how long does this last? Well, as soon as you qualify for this 50% decline, you can actually continue to get that credit for any quarter until you get back up above 80% of where you used to be. So if you had a 50% decline this quarter and then next quarter, I didn't get back up to 80% of the quarter from the comparison year from the year before, I can continue to get these credits all the way up until that point. So it's really interesting. So as soon as you start qualifying, you actually might qualify for a long period of time until your business gets back to pretty much normal revenue operations. Okay, there's another component of this CARES Act that's around delaying of these FICA taxes. For most small businesses, this isn't going to apply. More than likely because between the payroll protection loan and between the refundable employee retention credits, those benefits are going to be significantly more valuable than the delayment of the FICA taxes. And the reason why I say that is because you cannot do both. You cannot get a delay of your employer payroll taxes and take advantage of the payroll tax protection program and the employee retention credits. You have to pick. So why would anybody pick this? Well, I believe the people that are going to pick this are those that can't get the math to work out correctly on the payroll protection loan, or those that are above 500 employees, obviously. So your companies like Boeing are highly going to benefit from being able to skirt having to pay the payroll tax bill for quite a while. So how does it work? Well, you can defer up to 50% of your payroll taxes, your federal payroll taxes, until 12/31/2021, and then the remainder amount until 12/31/2022. which is incredible. That's a lot of deferral for a long period of time. I think it's really geared towards bigger businesses. I don't think this is going to benefit too many small businesses. You can do the same thing for the self-employed as well. It includes 50% of your self-employment taxes. So for those that are familiar with how self-employment taxes work, there's a formula there. Usually there's a reason why they get to that 50%. But if you think about the 50% that you have in self-employment taxes, you can do the same type of deferral program for self-employed, assuming you're not going to instead take the payroll protection loan. Okay.
This is coming up now. This could be a big deal for a lot of people on this.
This is amazing. When it works in a major way. It's not going to apply to everybody. If you've never had a net operating loss or your business is off to the races this year and you're not going to have one, don't worry about this. Not a big deal for you. If you've had a net operating loss at some point in the past, you might have a net operating loss this year. You are an active real estate business. Don't care if you have a net operating loss. If you're an active real estate, this piece is huge. Just talking to somebody today that we were going back and amending their prior tax returns for some other credits, specifically R&D credits and a few other deductions that we had looked at in the past. And we were going to find around, I think it was a little close to around $120,000 of benefit for them. Just submitted the forms, completed the studies. We're going to go pick up this $100,000, submitted it to the CPA. Then all of a sudden the CARES Act comes out. We look at it. We said, oh my goodness, we need to review this client again. Told the CPA push pause, reviewing his NOL situation. Now the R&D credits, although those were $100,000, didn't even stand up to the fact that we were going to be able to put back into this person's pocket over $900,000 in tax refunds due to this change in the law. So we started the engagement for something else. We ended the engagement with more than 9 times the benefit that we'd gone into beforehand, really more than 10 times the benefit that we'd gone into beforehand. So let's talk about it. So back when they did the Tax Cuts and Jobs Act in 2017, they came out with a lot of great opportunities to be able to lower taxes for the right entrepreneurs and small businesses and even individuals that did the appropriate amount of planning. One of the things, however, that they did in that was that they eliminated your ability to carry back any net operating losses to prior years. So in 2017 and beforehand, if I had a net operating loss, doesn't matter the amount in any given year, I could go and say, well, I could carry that forward to my future profits. Or if I was profitable the year before, or the year before, the year before, I can go up to 3 years back. I could apply that to any of my profits in the past, and any taxes I paid on those profits in the past, I could have refunded back to me. So it was a great benefit, and it makes sense. Why if I made a profit one year and the next year I had a loss, why shouldn't I be able to pay get that money back? Because I'm negative now. I'm behind. The government's ahead. So it was, I understand they were trying to, the reason this probably came out was because they were trying to figure out how to pay for the benefits that they were providing. And this is one of the ways they did it. Anyways, CARES Act comes along. They change these rules. Now for tax years 2018, 2019, 2020, we can carry back net operating losses back to 5 years. That one is amazing. 2, there's also this rule around carry forward limitations. So one of the things that came out was and this has been out for actually a long time, but there's a limitation on taxable income. So if your net operating loss is more than 80% of your taxable income, then you're limited to carrying over the lesser of 80% of your taxable income or your net operating loss, whichever one is less. So for some individuals, you think of married filing jointly, it's like, I might have a business, I lost 100,000. My wife has a job, she makes 200,000. My taxable income is 100,000. Now I'm limited to only being able to carry forward $80,000. So I just lost a $20,000 loss that I'll never be able to use against wiping out portion of my taxes. So they got rid of this, which allows for some opportunities. I'll explain that here I think it's easier to go through on this chart here. So existing, let's go through this. So I talked about this on 16 and 17, we could carry back 3 years previously, and we could carry forward 20 years. Doesn't really affect everybody. Within 20 years, certainly you've absorbed your losses. So what changed for those years in 2016 and 17? We still have the same 3-year carryback. We have an indefinite carry forward, which may be some benefit, probably not. But we removed the cap. And we removed the cap not only for 16, but we removed it for 16, 17, 18, 19, and 20. And so with the removal of the cap, that presents an opportunity in and of itself. Let's say there's no reason for you to take advantage of carrybacks. There might be a reason for you to go back and amend your return just so that you can pick up the 20% piece that you got capped on and carry it all the way forward to today. But let's talk about carrybacks. So in 2018, 19, and 20, like I mentioned beforehand, there's no carrybacks. Those were eliminated in the Tax Cuts and Jobs Act. Well, they're back. Now we can do a 5-year carryback for 2018, 19, and 20. The graph here looks a little off, but it's 2018, 19, and 20. And so if I had profit in 16 or 17 or even 15, the statute's a little bit different on carryback. So most people might be used to a 3-year statute on being able to amend returns related to certain types of credits and deductions. As it relates to the carryback rules, the statute allows you to go back further and carry back losses further. So if I can go all the way back to 2015 and look and see if I had profit in 2015, maybe I didn't have much profit in 16 or 17 or 18, I had a huge loss either this year or in 19, I carry that back to 15, all of a sudden I have money coming from the IRS for previous tax liabilities I had paid that are now being refunded to me. This can be massive. Another place where this can be a huge benefit is if I am an active real estate. So remember, this is around NOLs, net operating losses. It has to be an operating business. So if I'm an operating real estate business and I, have never heard about cost segregation, I probably should take a look at it. So a way for me to accelerate my depreciation inside my property. That's potentially a good thing to do, regardless of the situation that we're in now. But cost segregation has a new unique spin on it. So if beforehand you're familiar with it, you've looked at it, you've run the numbers, it didn't make sense to do the cost segregation, time to look at it again. Why? Because now I might be able to drive a massive net operating loss in my business this year, which usually is a reason not to do a cost segregation, because it's going to take me so long in order for me to pay off the acceleration of that depreciation. But now if I can take that huge net operating loss that I generated by accelerating my depreciation through cost segregation and look back over the last 5 years and find enough profit in the last 5 years to immediately apply that to, well, I just paid for my cost segregation day one, got all that money refunded to me, the math on the cost segregation checks out immediately. Huge benefit. So something to take a look at. So that's an example in active real estate where you may not have had net operating losses ever, but this other component where if you take this other strategy and you apply it to this current change in the law, all of a sudden they work in concert together to provide incredible savings.
Yeah, that's a big one right there. So we're nearing the end here. I know that this is a lot of information. I will say, if this is something you're going, how in the hell do I navigate this? Go to wealthfactory.com/private. And, this is something that we can support you with. We've partnered with these guys. We've been partners with them for several years now. We're also, when this is finished, we'll be having a conversation of some things that we could provide as resources to people that would be extraordinarily affordable to navigate this if you want to do it on your own. But wealthfactory.com/private is the best resource I give you. We'll get a little bit of information about you, and then we can put you in the right hands based upon your scenario and situation. So, David, as I know you're going to be finishing up here, I just want to say thanks. I mean, you've gone through so much in a pretty short period of time. Everything from these tax credits to the net operating losses to the loans that are available to the grants that are available. I mean, there is a wide variety of things. And I've admitted, I've sent some text messages, if people could see me on the screen, or some messages to my team because we were getting live updates because this is such a fluid situation. So, we'll continue to do that. That's why it's important to go to wealthfactory.com/private if you want some additional support beyond what you're learning here. So, David, I'll turn the time back to you for the last few minutes here.
Yeah, so in the last few minutes, obviously we've only scraped the surface of what's come out of the CARES Act. I think we've talked a lot about most of the big heavy hitters, especially as they apply to businesses. Slide I have up here now is just around those same NOLs. There's other limitations in there with AMT credits, et cetera. There's lots of reasons to look at amending your returns. Without going through the rest of the slide deck, I'll just end with a lot of the other components inside of the CARES Act has to do with individuals. So there's rebate checks that you can qualify for. Those are going to be more standard. It's either you qualify or you don't, but it's, again, never that simple. If you're on the fence, you're one of those individuals that says, dang, I'm a married family, and the cutoff is 198,000 and I made 210,000. Don't forget about qualified plans. Don't forget about certain things that you can use in short-term segments that in certain circumstances you might say, I would never do this. I would never consider this option. I would never consider this tool. It has interest and penalties and fees. Well, remember that certain circumstances, if you can lower your money, you can lower your taxable income, your adjustable rate, whether it's through charitable contributions or other forms of deductions for a short period of time, all of a sudden pick up a rebate check from the government that more than pays for the amount of the money that you put in, it starts to make sense again. So don't use bias to immediately assume something doesn't work immediately for a certain period of time, especially when you couple it with the fact of there's all of a sudden not a 10% withdrawal penalty. What does that mean? Does that mean I could put money into an IRA, pick up a deduction, all of a sudden get my rebate check, and then take the money back out without penalty? Probably. So interesting, unique tools that you can do as it relates to all these things. I think that's a lot of the main heavy hitters today, Garrett. And there's other things I'm sure we'll talk about as regs come out and as we dig more into the CARES Act. But I think for today, that's probably good.
Thanks for your time, David. As I said, you guys have been my go-to when it comes to advanced tax strategy, when it comes to navigating the more complex things out there. I think you've done a wonderful job of that today. I know that some of this, for those that might be new to some of the vernacular, might be like a little overwhelming. wealthfactory.com/private if that's the case. And, we can get common language for you, but we really had to cover a lot in a short period of time. I know that you've been working around the clock, so I'll let you complete here, David, unless there's the last thought or sentiment you want to give.
No, I think I'm good.
All right. Hey, everybody take care out there. We're here to help you navigate cash flow, and the chaotic times of today. This is Garrett Gunderson signing off.